What's going on, dividend chasers? It's a dividend bloodhound here, back with another investing episode. Today's episode we're talking about 3 undervalued oil companies that have got a really bright, sustainable future ahead of them, which is really good for us dividend investors, because these guys are usually the heavyweights, the stalwarts that pay probably some of the better dividends in your portfolio. If this video sounds like the video for you, then do please stick around till after the intro, and when we'll get into the actual fundamental analysis. That being said, if this video does bring you some value today, it'd be super great if you could hit the like button down on the corner here, and if you're brand new to this channel, do consider subscribing and ticking that notification bell as well. And without further ado, let's roll the intro and get into it. Catch you on the other side. Hey again guys, welcome into the video. So in today's episode we're talking about undervalued energy and oil companies. Now, as I'm sure you're well aware, since the health care pandemic and the health crisis began, the energy and oil sector has taken an absolute hammering. All prices on most, if not all, energy and oil companies are down a minimum of about 30% at the moment, and with good reason. There is a lot more supply than demand at the moment, so oil companies are struggling to store the oil that they've already extracted, and people just aren't using it at all, so the price per barrel has gone down, so what they're actually producing is far less valuable, and they're struggling to store it in the usual places, and they're having to hire out oil tankers to actually store this excess oil. And that's compounded by the fact that airplanes obviously are not flying at the moment, so that's not using fuel. I think I saw in our news recently that flights were down 84% on where they were this time last year. That is a huge amount of fuel not being used. And then if you flip that to the cruise industry, most cruise ships are also tied up alongside not burning fuel either. I mean, I went to Weymouth recently and there was about 8 or 9 cruise ships just tied up at anchor, not burning the sort of fuel that they usually would. The big heavyweights in the sector are doing their best to preserve cash and try and take care of themselves in terms of cost cutting and cutting their dividends, which is super important. Even though I'm invested in 2 of the companies that two out of the 3 companies that I'm going to show you today, a cut in the dividend does hurt and it hits us investors in the pocket. But if it's for the good of the business, then a dividend cut is not always a bad thing. And at the moment, these companies have to look after number one and make sure that they can continue to do business in the future, which, as I alluded to in the title, I think these 3 companies have got an absolute excellent chance at reinventing themselves, moving away from oil and becoming integrated energy companies, looking into fuels such as biofuel, hydrogen, and then renewables and natural gas across the line, not just being solely reliant on oil. And all 3 of these companies, which is why I've selected them today, are already in the process of doing that, and some have even started to accelerate the process due to the health crisis and the need to get carbon neutral as soon as possible. That brings me on nicely to my next point, that electricity is the demand for electricity is going up exponentially year on year. We are producing, and the need for electricity is just skyrocketing, and that is only going to get higher with the onset of all electric vehicles. Now, as you've seen, Tesla's taking the world by storm, and all the lead manufacturers are now following on from this. So there's going to be a huge amount of cars out there that are going to need to plug into the grid and charge off it. And these companies, each one of them, is ideally placed to become an integrated energy company and take advantage of doing this, whether that's supplying energy to your home or even owning their own EV forecourts, so that you can directly charge just like you would your petrol car. You go to a EV forecourt like a petrol station and charge up there with a supercharger just like you would with a Tesla supercharger. At the moment, all 3 of these companies are either at their record low or are very, very close to it. I'm actually going to mention the names of these companies now because I've just realised that I hadn't actually done that yet. So the companies we are looking at today are BP, British Petroleum, RDSB or Royal Dutch Shell Bravo shares, and Total SE. So two are obviously UK based and listed on the UK stock exchange, and then Total is based out of the French stock exchange over in Paris. I am a passionate believer that though these companies are heavily devalued at the moment with good reason, they're actually undervalued, and I think that they should be higher than they already are based on the future that they have got ahead of them and their future direction. They're already jumping towards renewables and accelerating that rate because they've realised that's where the future is. Oil cannot last forever, but at the same time it's still got a good few years in it yet to definitely build that money and invest it over in renewables so they can supply this thing called electricity that literally the world would collapse without nowadays. It's got its way into our lives to such an extent that we cannot get around without electricity, and these companies are going to be in an ideal place to supply it in the coming years for the foreseeable next 50 years and beyond, to be fair. These share prices of all three of these companies are obviously heavily reduced right now from where they were before, at least 30% down. But I actually think that that is going to be cheap, and to get in now would be remarkably cheap based on the future earnings and the future potential revenue of these companies. So yeah, they're under pressure right now, but as we come 3, 4, 5 years down the line and then decades down the line, as dividend investors we know that we're in this for the long term. Getting in at £10 a share for Shell or £2.40 a share for BP or €29-30 a share for Total, I think that is going to be stupidly cheap when we come to see where these companies are at in 10 years time, for example, and then the dividend being paid should be absolutely spot on as well. And that is why I'm a big believer in these companies, and I'm heavily investing towards these guys and averaging down my Shell and BP positions that I have. As I said, I'm invested in 2 out of 3 of these companies. That being said, I'm actually going to get in and have a look at the first company now. The first company is Total, listed on the French stock exchange over in Paris, one of the big heavyweight oil companies in the world. So let's get in, let's have a look at their fundamentals, and I'll catch you in the app. See you there. Hey again guys, welcome into the app. So as we can see here, this is Total, €29 a share, 17% down in the last 3 months and 38% down year to date, from a peak price in January this year of €50. So this company is a massive oil company, but also is big into gas, renewables, power, refining and chemicals, all of this sort of thing. Spot on for what this company does, and moving forward they're edging more and more towards renewables, as we've said. So the ticker is FP. They have a market cap of €82 billion, a PE ratio of 7.99, huge revenue of €148 billion, an EPS of €3.90, a high dividend yield of 8.61%, which is absolutely great. They have a net income of €11.27 billion, a profit margin of 6.39%, and a low debt to assets ratio of 57%. Hopping over to the growth metrics, even though I understand this isn't a growth company, it's also always good to look at revenue. So in the last 3 years, they're down a tiny bit at minus 3.63%, but 5-year revenue growth is actually at 11. They got earnings per share on 3 and 5 year respectively in double digits at 17 and 18% respectively. That means the company's getting far more efficient, which is great. And then we have a 3-year dividend growth of 5%. This company also has not had to cut its dividends. It's the only one out of the 3 that hasn't trimmed back its dividend for the financial health of the business, because their dividend is so well covered. They have enough money and enough cash flow to cover their dividend 2.1 times over, according to Dividend Max. And they have a dividend history looking back to 2006. They've paid it and held it and grown it in every single year except 2011. So that just shows you the great financial position this company is in. And yes, demand for its product has gone down, but that will be the same across all 3 of these companies, and they're all affected by exactly the same thing, and prices are down about the same accordingly. That being said, I'll wrap up for Total here, and I'll see you back in the outside world. Hey again guys, welcome back. So that was Total there. As you can see, quite a financially strong company. As for the dividend, that is the strongest dividend cover that we will see today. It's also got the highest dividend, so real plus points for that company. Highest dividend cover, highest dividend yield. The only issue with investing in this one as a UK based person or UK based investor is there is the French dividend tax to consider, which would be 15% gone from your investments, and this is well worth considering. Now the reason I've targeted these 3 companies, Shell, BP and Total, is they're already moving towards renewables, and there's other companies out there like Chevron and ExxonMobil that are a little bit slower to that side of things. And I think for me and my money, I want to future-proof it, and I think that Exxon could get caught short by not moving away from oil quick enough, shall we say. Anyway, I digress a little bit there. Moving on to the next company. Our next company is Shell. So let's get in there and let's have a look at their fundamentals. One of the most profitable companies in the world, despite the fact that it had to reduce its dividend recently by 66% to cope with the ongoing pandemic and make sure that it has enough money to sustain its operations until demand returns. Let's get in there and let's take a look. See you in there. Hey again guys, welcome back into the app. So yeah, now we are looking at Royal Dutch Shell, or RDSB. B because we are from the UK and we don't want to pay the same tax as the Dutch who would buy RDSA. As we can see, in the last 3 months down 24% due to the pandemic, and down 57% year to date, again for the same reasons. Has the ticker RDSB, a market cap of 87 billion, a PE ratio of 4.54, a huge revenue of 291 billion, so nearly over £250 billion in revenue. That is enormous. EPS of £2.52, a dividend yield. Trading 212 has not updated this yet, so the yield according to Dividend Max is now between 3.5% and 5%, depending on when you bought in your shares and if you're averaging down your position or not. So a yield of between 3 and 5% going forward, not 9.7 as you can see there. They have a net income of 15.84 billion and a profit margin of 4.59. Debt to assets 53%. This is going to be increasing this year. The same with Total, the same with BP. Because of the pandemic, the company is going to have to borrow some money to continue operations, and then reduce and cost cut in the meantime as well. Hopping over to the growth metrics then, we can see that 3 and 5 year revenue growth has been minus almost 4% in 3 years, but over 5 years up 13.87. EPS slightly down recently in 3 years, but over the 5 years 50% more efficient per share. That is absolutely amazing. And then we have the dividend has not been grown in a long time, and recently it has been cut, of course, but they did pay this dividend since World War One, which is absolutely huge and great history, and they are still paying their dividend now despite being in the middle of a pandemic, but they can still cover it at the moment 1.4 times over, so there's plenty of cash still spare to be able to pay this dividend, and then maybe in the longer term, as demand for oil returns and energy returns in the even longer term, they can raise this dividend and become a dividend growth company perhaps. So as we're looking, we've got £10 a share at the moment. Before the pandemic, we were looking at £23 a share. Peak pandemic, when the main sell-off dropped to £9.22 a share, and then we've been up as high as £14 to £15 since. Now my position is considerably down at the moment. My average price per share is £15, so I'm hoping to continue buying at this price to bring my average share down to about the 12 to £13 mark, which will mean that any sort of increase in revenue will bring the share price back above it, and I will be back in the green very quickly and still receiving my dividend. That being said, I will wrap up for RDSB, Royal Dutch Shell here, and I'll catch you back in the outside world. See you there. Hey again guys, welcome back to the real world. So that was RDSB there, Royal Dutch Shell. Actually one of my favourite companies out there for paying dividends. I know the yield is only between 3 and 5% these days, so it has came down a bit, but I just know that they endeavour to always pay their dividend. The history of paying it since World War II, it just speaks for itself. As a British investor, there's no dividend tax to pay against it. I have every faith in the future that they are going to grow it as well and become more of a dividend growth company. And it is just, yeah, an absolute colossal profit making company, and really moving to future proof itself by looking at biofuels, hydrogen, investing heavily in renewables to really become, might even be the first full oil company to turn into an integrated energy company, and that will sustain this country and many other countries' energy needs and electricity needs and so forth for the future. And buying in at just a £10 a share to me is an absolute bargain. I genuinely love this company, and I think it will be one of my biggest, if not the biggest position in my portfolio soon. Have a lot of faith in RDSB. Right, anyway, moving on to the final company, that is BP, British Petroleum. This is another fantastic energy company. Came through the Deepwater Horizon crisis that many people will argue was obviously their fault, but the financial strength shown by this company in dealing with the cleanup operation, paying for it, paying the compensation, bringing back the dividend as quick as it did, really screams testament to just how strong this company is and its dedication to its investors and its dividends. That being said, let's actually get in and have a look. It did recently announce that it's going to shift massively towards renewables. There was a big deal out recently where they bought a huge sector and a huge chunk in a wind farm off the American coast, and that's just them backing their talk basically of going for renewables, and invested billions of pounds in doing so. And their CEO recently announced that that's only going to be the start, and they're going to increase exponentially just how much they invest in renewables, and then of course generate profit from that. Let's get in there, let's take a look at their fundamentals. I'll catch you in there. Hey again guys, welcome into the app for the final time today, and we are looking at, of course, BP. Recently, off the back of a 50% dividend cut, they have the share price actually sustained okay from this. It was expected, as their dividend yield was well into double digits, but the forward yield was still 5%, and for most dividend investors that is certainly good enough for them, and likewise for me. I'm invested in this company as well. It's not as big as my Shell position, but I'm definitely in on this company for the long term as well. As we can see, over the last 3 months or so, it's down 24%, and year to date it is down 53%. Peak sell-off in the crisis down to 242. The price is only just above that at the moment. It's a great time to buy in my opinion, and was up at £4.90 at the start of the year, so a long way to go and a big upside as we move forward. So the ticker is BP. They have a market cap of 50 billion, the smallest company we are looking at today in terms of market capitalisation. A PE ratio of 4.44, big revenue of 215 billion, earnings per share of 56p. Dividend yield, as I explained, is now more the 5 to 6% side of things. Trading 212 obviously hasn't updated that yet. We have a net income of £4 billion, a profit margin of 1.45. That is a little bit low, obviously plenty of money being made, but I'd like to see that a little bit higher, and that is the lowest profit margin of the three companies we've looked at today. A debt to assets ratio of 66%, that's the highest debt to assets ratio as well. This is only going to get a little bit higher due to the health crisis. If we pop on over to the growth metrics, we can see that 3-year revenue is down 4.6%, slightly higher than the other two, but the other two again experienced reduction in revenue over the same period. But then 5-year revenue growth is the highest we've seen today at 15%. EPS growth also not so good over the last 3 years, down almost 1%, but then over the 5 years, especially since Deepwater Horizon, that EPS has grown massively, 219%. And then they've grown until very recently their dividend at 3% a year for the last 3 years, but now that has obviously been trimmed back 50% for the financial good of the company. This company again has done particularly well over the last decade or so since Deepwater to return everything to where it was, essentially its financial health and its dividend. And I believe if they survive that, again, they can certainly survive this, and are big into going towards the renewables energy. The CEO has massively announced a change in strategy to really target that, and that to me screams future-proofing themselves and a sustainable dividend for essentially the rest of my life if I see fit. And that is exactly why I see this company as a buy opportunity at this price for absolute certain, and is going to be more than okay in the long term to produce passive income for you. That being said, I'm going to wrap up here, and I'll see you back out in the real world. See you there. Hey again guys, welcome back to the real world. That was BP there. I've done a video on this company in the past rating whether it is a buy or not. I genuinely believe, especially with its recent change in strategy and future-proofing itself to become an integrated energy company just like Shell and Total, these three companies have got a brilliant future ahead of them to supply our energy needs, not just to the UK but across Europe and France as well. And in the meantime, that share price is going to grow little bit by little bit, and so are the dividends. They're either going to be sustained or grown as well. They're going to have plenty of cash to do so, because the need for electricity is only going up year on year on year, and with the advent of electric vehicles and electric trucks, etc., the need for energy is only going to get greater, and these companies are ideally placed to do so. So getting in while they're so cheap at the moment is an absolutely unpassable, for me personally, an unpassable opportunity, and I'm working really hard to buy as many shares in these companies as I can, the two that I've selected to invest in, BP and Royal Dutch Shell, to really build my position as big as I can while the getting is good essentially and the share prices are so cheap. That being said, I really hope you've enjoyed this video today guys. If that is the case, please do consider liking the video and also sharing it to your friends as well. That would be absolutely fantastic. And if you haven't subscribed yet, it would be brilliant if you used now as the opportunity to do so, and even tick that notification bell as well. That being said, I really do hope I can see you in another investing episode. See you in the next one. Bye bye.